Hello everyone and welcome to another episode of Multifamily Monday. My name is Jesse Greer and I'm the Vice President of Investments and Multifamily at Avis & Young. And today, just like always, I have a very special guest with me, Shannon. Thank you for joining me.
Thank you for having me. I'm happy to meet you today.
Oh, this is going to be an exciting conversation too. In fact, we had a little bit of a prelude going into the video. But before I get into that, Shannon, I'd like to introduce you. So this is Shannon Diehl, the Director of Operations for Northern Nevada at FPI Management. So what does that mean to be the Director of Operations?
Well, FPI Management is a third-party management company. So we're a full-service company. We do everything from acquisitions to property management to transitions off if there's a sale and everything in between. So because we're third-party, we have a variety of different properties. We have everything from Section 8, tax credit, to high-end lease-ups, and again, everything in between. So my main role is to have client relations, talk about the market with them, educate them, and then I oversee the portfolio managers who actually do the day-to-day work of the property management.
So let's talk about that real quick because I think there is a significant amount of data that you receive on a daily basis because you manage 4 portfolio managers, which equates to how many on-site personnel?
Approximately 150 employees.
150 employees. Now, this is all in Northern Nevada.
Correct.
Yeah, so no Las Vegas, no Northern California. You are specific to this market.
Correct.
Fascinating.
Yeah, the bulk of our portfolio is in Reno and Sparks, and then we do have a sprinkling in Carson City as well.
Yeah. So needless to say, we're sitting here with someone that really knows the market. And let me equate that to number of properties for our viewers. So FPI Management manages 38 properties, and the majority of these are 80 plus units. So what does that mean? That means you manage close to 7,200 units.
That's correct.
I want to give perspective to this, right?
Yes.
So listen to this. In Northern Nevada, we have roughly 1,114 properties that we track, which is the lion's share of 5 plus multifamily units, right? Of those, roughly 80 plus units is 175 properties, or roughly 35,000 units. You manage 22% of the market inventory by properties and by units.
Yes, we do.
Wow.
And we're really proud of that.
Yes.
Yeah, we are really proud of that.
Amazing. And you're consistently growing too.
We are.
Yeah.
We are definitely growing. A little anecdote about me is that when I started in this market 17 years ago, I was the only portfolio manager and we had 5 properties.
Amazing.
So, and all of our growth has been organic, word of mouth from other clients. And so I'm really proud of that it was just me, and now we've grown to almost 7,200 units.
That is amazing.
Yeah.
Kudos to you. That's an amazing growth right
Thank
there.
you. Yeah, we're really proud of that.
Absolutely. So let's dive into really the crux of the conversation, right? And understanding the marketplace. I feel like there's a lot of uncertainty right now when you look at our vacancy, when you look at our average rents, when all the new construction coming in. Where are we in this marketplace? And I feel like there's a lot of uncertainty behind that. Maybe you can help with that a little bit.
There definitely is. So let me get my crystal ball.
You're right.
Yeah. Because that's what I wish I had sometimes. But yeah, there is. And there's a lot of misconceptions out there and a lot of, reports that I track and that I kind of, I look at the reports and pull out what I think is the most beneficial. But really, we have boots on the ground.
Sure.
And like I said, we have, tax credit, but we also have the lease up. So I can talk about what's going on with the new construction and how that's even impacting the overall market. So I think that that's probably the most beneficial is just what we're experiencing and what I think is going to happen. So as we know, there was a housing shortage.
Sure.
There definitely was, and it was all over the news, and developers read it. And they came to Northern Nevada and started building. And we were very excited about that. We were very excited about the new construction and also the job growth that we were experiencing. Not just Tesla, there's a lot more than Tesla that brought this on. And so it was great. However, what I see is that, yes, jobs are coming to our market. Yes, jobs have come to our market that led us to this point. However, the building is coming quicker than the jobs are coming. So what that means for our market is that while we're waiting for these jobs to come, which they are coming, and the EDON reports are very accurate in tracking that, we might have a little bit excess inventory. And we may have that excess inventory for 18 to 24 months if EDON's job predictions are right and all of those new properties come to fruition. So it's a little bit scary.
Yeah.
But what I tell my clients is that it's okay. We're going to get through this. It's nowhere near what we went through in 2009 and 10. It's nothing like that. It's just that we have to be aware of it, and we're not going to get those record 10 to 12% rent growth that we were all high-fiving about and
About
super
3 years
excited.
ago, right?
Exactly. Yeah, we were really excited. We're still projecting 3 to 4% rent growth, which is
So more inflationary, a little more than beating inflation,
Exactly.
but more back to, I guess, normalcy, if that's a thing.
Exactly.
Yeah.
Exactly. And so we are still going to see rent growth, but what we are also going to see is concessions in this market. We're all competing for the same renter.
Yeah.
So we are going to see concessions, and we're probably going to see higher vacancy factor than what we're used to seeing. So I think if we're just prepared for that, and for me, educating my clients,
Absolutely.
we should, be able to come out in the next 2 years.
So let's talk about that, because what's interesting, and you said something here, so I'm going to give you full credit for this. We're building like jobs are here now, but that are 2 years out.
Correct.
Right? Now, we talked about vacancy, and we kind of briefly discussed average rents, right? So a very well-known report in this market is by the Johnson Perkins Griffin Appraisal Group, right? Now, what's unique about this report is that it covers 92 properties, okay? And these properties are 80 plus units, and they're all affordable, right? So there is a good swath of what I would call the, city of Reno Sparks, but in looking at how many properties that you manage, I'd be curious to know kind of the difference in what you're seeing. And I'll start by this. So the change from third quarter to fourth quarter in average vacancy was 3.3 to 3.96, which is still healthy, even though it's gone up. Average rents have gone down from about $13.45 a month to $13.24. Now, understanding that you deal with the amount of properties and units that you do you feel that that is representative based upon your portfolio?
I do not. And again, I love this report. And like I said at the beginning, is I take all of these reports and pull out the relevant data. And of course, this is 92 properties. And you've already shared the numbers. So what we're seeing, if I just take a stabilized asset, say B property, we're seeing about 5% vacancy, but we're barely holding on to that.
Yeah.
I do think that we're going to have a little bit more of a slip, and we are seeing concessions on those B and C properties.
Can you give us an example of types of concessions that are being thrown out there?
Yeah. So what first started in this market was the new construction, which makes sense. They're 200 units to the market. They needed to offer free rent to bring people in. So we first started to see it on the new construction buildings, but it didn't impact the value adds, the B and C communities, because of the rent difference.
Sure.
So
which is significant.
It is. It is. A few $100s. And one thing to note is that our salaries haven't grown in Reno Sparks with the rent.
Correct.
So now price becomes more of a factor for our average renter in Northern Nevada. So again, the new construction had concessions, high rents. It didn't really impact the stabilized buildings until they realized they couldn't rent them because there was so much competition. So they started doing 2 months free, lowering the rents. In some cases, I've seen some of the buildings go down $500. And that's where we started to feel it in our stabilized assets. Because then our average renter could stretch their budget by only $100 and get 2 months free and go to new construction. So it's been this shift in our market that we feel, and almost a ripple effect, where it started with the new construction, it's going down. And again, I don't want to be gloom and doom or anything like that.
No, but I think realism is very important for this market, especially for our audience.
Exactly.
Yeah,
so back to your original question about the vacancy factor and the average rents, we're not experiencing that boots on the ground feeling. Like I said, it's more like the 5%, and it could be a little bit higher based on what we just talked about.
So then basically you're thinking between 5 and 7%, right, overall. I mean, some communities can experience higher vacancy than others. Still a healthy vacancy, though.
Yes.
I think we've become so accustomed to the 1, the 2, the 3%, the 13% year-over-year rent growth that, coming back to normalcy is hard for a lot of these investors.
It really is. It really is. And we have to also talk about, when the investors, when they start building, they start 2-3 years out. It now costs $250,000 a door to build. And at that point, it was astronomical. The price per door was not for sale, it's not that high yet. So they all had to be luxury apartments to get those high rents.
It's the only way you can justify the underwriting for these properties. So I think it's a very valid point that you bring up, Shannon, because when you have your clients that come into this market, they underwrite for a certain rental rate, right, to get a certain return on investment. So, these investors that are currently building or almost completing or maybe looking at a second phase, do you find that they're starting to pull back because of construction costs and land costs and everything else that's going up?
Yes,
Okay.
I do see that, and I also have seen actually deals that were done. They had entitlements that they actually backed out, and they're holding on to their land, which I think is smart right now to hold on to in a couple years.
Absolutely.
So yeah, we are seeing that, and they only have 2 years typically to get out of their construction loan, so they have to lease these apartments. However, like you mentioned, they've underwrote them at really high rents. And if you go back to the average income of the Northern Nevada resident, they're not being able to afford those rents. So it's just an interesting dynamic right now. And one thing to point out is the jobs that are coming are still mostly factory industry jobs that are still not going to be able to afford those rents unless they have roommates. And we do see a lot of roommates from that industry where they will go to the luxury apartments because of the amenities, and they will do roommates. So we do see that, but it's not the norm.
Yeah.
So it's just something that's interesting to me that I am watching because, we only can have so much luxury product for our salary. And so we are starting to see some people move out to where it's more affordable in Dayton and Fernley because their salary hasn't grown with the rents.
Fascinating. Initially, when this started happening, did you increase the allocation of their income to the rents? Or was it more of just reducing rents or, trying to get concessions out first?
It was really the latter. So trying to reduce the rents and get the concessions. And budgeting for concessions, that's something we didn't do for so long, and having to educate our clients that's kind of the normal right now is we have to do these concessions and be creative in them. Some of the lease-up communities will buy out other residents' leases.
Because sometimes,
competition.
Yeah, I was going to say sometimes, and it's more common nowadays to where leases have an option that you can exercise within that 12, 18, or 6-month period where you have to pay a full month's worth of rent, but you can vacate the lease.
Correct.
And so you're talking about something like that some communities would be willing to pay to try to incentivize them to come to that community.
Absolutely. That's how competitive it's gotten. Wow. It's like, I'm not looking for 3 months. It's okay, we'll buy you out of your lease, move in now. And, so on the other end, when it's happening to us and that's our resident, we have to have another negotiating tool. So it's this back and forth with, well, you're gonna offer that, no, I'm gonna offer this, and have to try to compete for that same renter that we're all trying to fight to keep.
And it's amazing because when you look at 2020 and 2021, that's when the lion's share of this new development is hitting the market.
It really is. So we saw a healthy inventory come in 2018, but again, the jobs were still coming at that time. So it was, it didn't really impact us too much. Where it really started to impact us was in 2019, where we started to feel that. And, it's very seasonal here in this market for renting. And when I first noticed it is when we didn't get our second quarter traffic uptick. Normally traffic really comes when people get their tax returns and the renters are ready to move.
Makes sense.
And we didn't really get that. Well, what I did notice is that traffic didn't stop. It just was spread out. So that's when we first started to realize it. So and then we had this, that's when I first started tracking the inventory and what's going on and maybe having some excess inventory. So 19 was kind of a learning year for us. And now looking forward to 2020, we have a lot of inventory coming on this year. Yeah. So this, like you said, the bulk of it is going to be 2020 and then a little bit more in 2021 with some phase 2s and things like that. So it's going to be interesting.
So when you look at the market right now, the majority of the development is where there's remaining land, right? So you have Northeast Sparks, Spanish Springs, you have Cold Springs, right? And you have South Meadows, Reno as well. Between the three markets, which one would you say is being overdeveloped or is the most challenging to lease out?
Well, that's been a switch too. So, so it used to be, when I say used to, I'm talking like in the last 24 months because that's when this kind of crazy shift happened, is that East Sparks was really desirable. Yeah. And it made sense because of the trick plant.
Proximity.
Exactly.
Right? Yeah.
Vista was the closest, and so we started to see a lot of growth around the Legends, the Marina District, a lot of new stuff going in there, and it was very desirable. Also noted is Victorian Square. Yeah. Jay Witt's brought in a ton of units there, so that kind of Sparks corridor was very desirable, and we were seeing a lot of building. Well, it's almost changed a little bit, but I think it's changed because of the affordability. Okay. And so now we're seeing a lot more renters wanting to be in Northwest Reno. You mentioned Cold Springs. We're starting to get some development out in the valleys out there, and I think it's because of the affordability.
Got it. So it's really not by choice, it sounds like, right? It's by necessity.
Exactly.
And necessity of product that offers the price point that the average consumer can afford.
Exactly.
Okay.
Exactly. And we've seen a big shift in 3 bedrooms where families used to be able to afford a single family home. They're priced out. So our 3 bedroom apartments constantly stay full. And I attribute that to the housing market. So, we're seeing a lot more builders building 3 bedrooms because of that.
Yeah. So does that make you a little nervous? And assuming our single family home developer side can keep up with inventory, which they're having a tough time just as, multifamily.
Exactly.
Yeah. But if they do start catching up on inventory and they have that for sale home that hits the price point that rents are going for now, do you think there's going to be maybe an exodus of renters back to home ownership?
It could happen, and if it's going to, I feel like it's going to be in this next couple of years.
Okay.
Because multifamily, and this, kind of follows the real estate market. So what's going to happen in our industry usually happens in the real estate market first. When we saw home prices start to come down, excess inventory, then we're a little bit behind that. So I do think that it may happen in the next couple of years as prices soften a little bit for home prices, and those families can afford it. But again, I think it's all going to come back up.
Okay.
So what I'm talking is very short term, like I said, 18 to 24 months, but then those jobs are going to keep coming and we're going to level up. So it's going to be, like I said, we're going to watch it.
Yeah, no, absolutely. And if only we had that crystal ball.
I wish we did.
So basically what you're saying is you're really tracking EDON and you're tracking their EPIC reports and you're tracking that population growth and that average wage growth as well, because those are going to be the two. Well, let me restate that. I think the median wage growth is going to be probably the most important for affordability and maintaining these rental rates, right? Population is coming. We know that.
Exactly.
Right? So it's a matter of saying, can the new population coming in and the new jobs coming into the area promoted by EDON, do they have the salaries available for that?
That's exactly the key point.
Yeah.
Yes, and so that's what the jobs are coming.
Yeah.
They're all coming. We know that, and I believe in EDON that these jobs are coming to fruition. But can they afford the product that we're building?
Sure.
So the good news is though we have seen a shift, and there's a little bit more affordable buildings being built. Vintage housing has built over 600 units of tax credit affordable units that have a waiting list. Kramer House just came down with their kind of shared living, $550 a door. So we are seeing developers recognize that, which is good. And that will help level out the rental rates without, government trying to do rent control. And we don't really want to get into that, but, so I think that developers are starting to learn that a little bit because of the wages that you mentioned.
So it sounds like if you're going to be a developer in this market and you're going to look to continue to grow with this market, you have to be creative. I mean, you have to look at urban infill. You have to look at different options of maybe shared communal areas, right? To be able to support the rents and the cost to run that property for it to make sense.
Exactly.
Yeah.
Exactly. And that makes me happy to see, because like we said, for so long, everything was coming in was luxury, high rents, and, our industry took a really bad rap by the media that we were greedy, and, we talked about why the rents were so high because it was so expensive to build. So I do like to see these developers being creative and coming up with alternative solutions. That will help.
And don't get us wrong, I mean, it costs a fortune to buy a piece of dirt. Construction costs are still way up. And I think to your point, it is a miscommunication from the media, because really, if you were to develop a property in this market, what you don't realize is the red tapes that you have to go through, the different city agencies that you have to work with. And granted, there is some fresh blood out there, and I actually have some great videos that we did on this, but the cities are trying to help developers. They're trying to be a partner, right? And not trying to be a hindrance, which is fantastic and what we need.
They really are.
So basically it sounds like what I'm hearing from you is we have maybe a 1.5 to 2 year lull where it's just kind of a hold and see, right? Let's see what's going to happen. And that 2 years is going to be predicated upon the average income that this market can see.
Yes.
So I have a feeling it's going to be probably two things. It's going to be that plus rents going down. And I think you're going to find a happy median somewhere. Do you think that sounds?
I absolutely agree with you. And I think it's naturally happening already.
Yeah.
So I definitely agree with you. That's a really good summation.
Yeah.
Yeah.
Fantastic. Well, Shannon, I tell you what, I really appreciate your time. And this is what 20% market share looks like right here, the wisdom that we're getting from Shannon. So we really appreciate that.
Thank you.
Shannon, if anyone wants to, talk to you about property management, talk to you about development or anything else in this marketplace, how do they go about doing that?
Well, the easiest way would probably be to go to the SPI management website, which is spimgt.com. And from there's a way that you can reach out to our corporate office, and they know how to find me.
Fantastic.
Yeah.
Shannon, I appreciate your time.
Yeah, thank you for
Have a
having
great
me.
day.
You
Thank
too.
you.
Thank you.